My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate, teach you, and put this crazy market in context. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. The S&P 500 just hit a new all-time high, taking out the previous peak on February 19th. And all I heard is it's because we're having a V-shaped recovery. Wrong, wrong, wrong. They know nothing. Not just wrong, but actually laughable. In a V-shaped recovery, the Dow Jones Industrial Average would be hitting new highs. But this move's been led by the NASDAQ and the S&P, including today. That Dow Jones Industrial's lost 67 points, even as the S&P advanced 0.23% and the NASDAQ gained a staggering 0.73%. Now, you don't need to be a rocket scientist to figure this out. Just look at the stocks that have brought us to these levels. They're not the recovery plays. In fact, they are the opposite. They are stocks that tend to do well because of what we call secular considerations. No, not secular like non-religious, but secular as in they are doing well because of trends in their own industries, not the economy. Far from it. Allow me to explain. We have had a magnificent V-shaped recovery in the stock market. But the stock market's not a great reflection of the broader economy anymore. If anything, the actual economy is in precarious shape, especially now that the government stimulus package has run out and Congress went home for the summer rather than trying to come up with a replacement. And don't even get me started on the destruction of small business that's about to happen. So I want to put this whole notion of a V-shaped recovery on trial because it doesn't stand up to even the most mild of scrutiny. First witness for the prosecution in this list of stocks that have done well is PayPal. Yes, it's the best performer in the S&P since the February peak. Now, last week, we interviewed CEO Dan Schulman. He made it clear that PayPal's business is on fire because nobody wants to touch cash when it could be bathed in COVID. Nobody wants to input their PIN in a debit card reader for the same reason. We need contactless payments, and that's PayPal in a nutshell. When you see that this stock's rallied 57% since the top of February 19th, you need to know that's terrible for the regular banks. J.P. Morgan, Bank of America, Citigroup, Wells Fargo, they all could be partners with PayPal, but it's just bad for their business. See, financial tech plays like PayPal thrive when money managers are afraid to own the real financials with actual credit risk. They need some financial exposure, though, so they buy fintech because they don't want that credit risk if the economy's about to go down again, which is what they think. Second witness, Nvidia, the company I renamed my 13-year-old rescue dog after. By the way, Nvidia has a card to be able to get into Nvidia. He does. It's a little green card. It's his ID card. You know, you swap it. Now he wouldn't know how to swap it. Anyway, he's dumb as a bag of hammers. Anyway, unlike Nvidia, the dog, this company can hunt. The chip maker dominates all sorts of incredibly burgeoning markets: machine learning, artificial intelligence, edge computing, gaming, data center. Nvidia today is what Intel was in the 90s. CEO Jensen Huang is a modern-day Leonardo da Vinci. And he's an architect, he's an inventor, he's an engineer, and he's a visionary. Not to mention, he's also the nicest chief executive I've met in my 15 years doing the show. No offense to Mark Benioff, a very close second. Plus, Huang has a cool leather jacket that I could never pull off. Nvidia reports tomorrow, and I have no idea if they'll be able to justify the stock's 55% gain since the February top because the bar is now so high. But the point here is that Nvidia is not the kind of stock Wall Street flocks to in a rapid economic recovery. It's anti-cyclical. It figures out how to make things that don't even exist in most of our minds. Third witness is Apple, up 43% from the February top. You know, what can I say here? For years, I've said you should own Apple, not trade it. And I stuck to the party line even after the pandemic got rolling. The stock got hit with wave after wave of downgrades, a slew of negative stories about how it could be crushed by China or knocked out by lockdown or beaten by the worldwide recession. None of it mattered to me. The company put up incredible numbers because iPhones and iPads and laptops are essential in the stay-at-home economy. The rapidly growing service revenue stream didn't skip a beat, and the company's products are loved with a 99%. Well, what do you say? Satisfaction? The best there is? Apple's not a recovery play at all. It's a secular growth play that works in good times and bad. I have a thing I like to say about Apple. I say, own it, don't trade it. Fourth witness is Cramer fave Advanced Micro Devices. AMD is just like Nvidia, another terrific semiconductor company. It's taking share from Intel thanks to the leadership of the incredible CEO, Lisa Su. This one's all about PCs and data centers. After years of playing catch-up, this was the quarter where AMD decisively beat Intel because they can now make smaller chips that Intel can't. No wonder the stock's up 38% since the S&P peaked in February. Once again, AMD's not a recovery play. This is a classic David and Goliath story. It's biblical. As these semiconductors get more complicated, you need better technology to design them, like the technology from Cadence Design Systems. The fifth best performer, up 36% from the previous highs. Cadence is a pretty opaque company, but it tells the same story. We're looking at a tech rally, not a recovery rally. Witness number 6, Corvo, which is not to be confused with Cuervo, the tequila we serve at Bar San Miguel, my small plate Mexican restaurant that's struggling mightily with social distancing in Brooklyn. Corvo is another chip maker with a stock that's up 27% from the February peak. Why, you ask? Because they make radio chips for, yep, you got it, iPhone. Have a good client, we'll travel. Witness 7's Qualcomm. Witness says Qualcomm tells the exact same story. Their intellectual property makes cell phones possible, and they've been winning some major lawsuits, giving them a larger cut from companies like Apple. That's why Qualcomm's up 24% from February highs. Nothing to do with the economy. Next up, we got a semiconductor equipment maker, KLA-Tencor, up 22% over the same period. Again, we're selling lots of gadgets for the stay-at-home economy. These gadgets need chips, and to make more chips, you need machinery from KLA-Tencor or one of its peers, Lam Research, which is up 12% and was one of the best-performing stocks in the whole market last year. Not a recovery. Witness number 9, Servicenow, the cloud-based software company that helps businesses automate all sorts of information technology and back-office jobs. Servicenow is one of our cloud kings. The new CEO, Bill McDermott, formerly of SAP, came in hot, using his massive Rolodex to win a ton of new clients. Stock's up 22% from the February top, and it's not done. Once again, this is a digitization stock, not a recovery stock. Finally, number 10 is Synopsys, which is in the same wheelhouse as the Cadence Design Company. For that superior semiconductor design work, it's rallied 21% since the S&P's last peak. Now, for those of you who think I'm actually cherry-picking, the next 10 best performers look pretty similar. 3 semiconductor and semiconductor equipment stocks, 1 work-from-home play, 2 fintechs, 1 cell phone component stock, 2 e-commerce names, and Microsoft. In short, the S&P 500 is not making new highs because of the industrials, the apparel stocks, or the retail, or the banks that want small businesses and companies that are hiring. No! This move's been fueled by the biggest story of the COVID recession, digitization. And when we talk about digitizing the economy, you know what that's shorthand for? Cut out the fat. With the fat being, alas, the people who are part of the real economy. When you can't afford to hire people, you bring in this brigade of hardware and software companies, and they do it for you. And they do it, let's just say, in brutal fashion. Meanwhile, the industrials are nothing to write home about. The financials are dreadful. Retail's got a few winners, Home Depot, Walmart, offset by a lot of losers, like bankrupt companies that are too small to talk about, and Kohl's or Nordstrom. The winners in this market are the companies that are most divorced from the underlying economy. They're not plays on a V-shaped recovery. There isn't one. They're plays on an L-shaped economy that's going nowhere without more stimulus. Here's the bottom line. The S&P's new highs are a tale told by an idiot, full of sound and fury, signifying nothing about the hardship of millions of people on food stamps, or the millions about to be fired from service jobs, or the homeless, or the people who are just huddled at home, waiting for the vaccine, which currently feels a lot like waiting for good dough.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.